All right, so today we're diving into the one story that everyone in tech is talking about, the AI revolution. It's this incredible story of explosive growth, just staggering amounts of money being thrown around, and honestly, boundless optimism. But, it's also a story about some powerful new headwinds and a fundamental shift in the rules of the game. So, what happens when this unstoppable force of AI meets some, very immovable objects? Let's break it all down.
And this quote from Qualcomm CEO really just nails the whole mood, doesn't it? The belief isn't just that AI is the next big thing, it's that it might be the biggest thing we have ever seen, and we still can't really wrap our heads around how big it's going to get. And that feeling, right there, is the starting point for everything we're seeing in the market.
So that brings us to the big question for this whole explainer. What happens when this tech gold rush runs headfirst into some really tough global challenges? We're talking economic slowdowns, not having enough skilled people, and all sorts of geopolitical drama. That's the collision we're going to get into. Okay, first things first, let's get a handle on the sheer scale of this boom. Because the numbers behind this AI gold rush are, and I'm not exaggerating here, they're mind-boggling. It's like a fire hose of cash being pointed directly at anything and everything that has to do with AI. So let's start at the very beginning, venture capital. Over the last year, venture investment in software hit $127 billion. That's the second highest level ever, and it was driven almost entirely by this absolute frenzy to fund the next big AI startup.
But it's not just the little guys, not by a long shot. The giants are spending even more. Big tech companies, think Meta, Alphabet, Amazon, Microsoft, they're on track to spend a combined $400 billion next year. And that's just on the infrastructure. The chips, the servers, the data centers, all the stuff needed to power their massive AI ambitions.
And if we look a little further down the road, this trend just gets faster. Global spending on AI is set to blow past $630 billion by 2028. We're talking about growth of nearly 30% year after year. The momentum here is, wow, it's just undeniable.
Now check this out. This chart from JP Morgan really tells the story. It shows the slice of the venture capital pie that's going to AI startups. Just look at that insane climb on the right, especially after 2022. It is a near total takeover of venture funding. Any software that isn't AI, well, it's kind of being left in the dust. So the takeaway is crucial. This isn't just another trend. It's a complete rewiring of where the money is going.
But here's the thing. As we all know, no market just goes up and up in a straight line forever, right? And now we're starting to see the first little cracks appear, the first signs of a reality check. That boundless optimism is beginning to bump up against some very real-world friction.
Let's go right to the source, the folks making the chips. This recent headline about TSMC, the company that pretty much makes the chips for everybody, is a real warning shot. When their sales growth, which has been fueled by AI, starts to slow down, it's a signal that maybe, just maybe, that insatiable demand has some limits.
And this next chart paints the picture perfectly. It shows you the revenue growth for software companies right when they go public. See how the bars for 2023 and 2024 are way shorter than the years before? It means that even the star companies, the ones good enough to hit the public market, are growing slower. The market's appetite is definitely changing.
And all of this forces a massive shift in strategy. The old way of thinking, fueled by easy money, was growth at all costs. Just burn cash, grab as much market share as you can, and we'll figure out profits later. But the new reality, investors want to see a clear path to actually making money. They're demanding efficiency. It's a whole new ballgame out there.
So on top of a cooling market, the entire tech industry now has to navigate what you could call a geopolitical gauntlet. These are huge external pressures that no single company, no matter how big and powerful, can really control.
This data from a KPMG survey of chip executives is so telling. Look at the top two biggest issues facing the industry, tied at 40% each. Talent risk and territorialism, which is just a fancy word for tariffs and trade fights. Now think about that. For these execs, finding enough skilled people is just as big a worry as a full-blown trade war. That's wild. And this talent crisis, it's not some abstract idea. It's a real numbers problem. The U.S. is looking at a shortage of 67,000 semiconductor workers. Europe needs 400,000 more people to hit their chip goals. India could be short 300,000 professionals. I mean, you simply cannot build the future of AI if you don't have the people to actually do the work.
And this chart digs a little deeper into that whole territorialism concern. When they asked these executives to get specific about their fears, armed conflict and tariffs were number 1 and 2. A staggering 69% said armed conflicts were a high concern. The industry is so global, so interconnected, it makes it incredibly vulnerable to these kinds of shocks.
And if you want to see what this looks like in the real world, just look at this table. These are actual U.S. tariff hikes on goods from India. And we are not talking about small little changes here. Textiles, auto parts, jewelry, boom, they all jump from a 25% tariff to 50%. This is what a trade war actually does. Costs can literally double overnight, blowing up supply chains that have been in place for decades. And yeah, these specific tariffs aren't on microchips, but they show you just how fast the global trade environment can turn hostile. And that is a direct threat to the complex international supply chain that AI absolutely depends on. So, you've got this perfect storm of market shifts and global pressures. How on earth do companies survive, let alone thrive? Well, they have to adopt a totally new playbook, a new set of rules for growth that puts resilience right up there with innovation.
So here's what that playbook looks like based on what industry leaders are doing right now. Number 1, diversify that supply chain. You just can't be dependent on one country or one supplier anymore. 2, invest in your people. If you can't find the talent, you have to build it yourself through training. 3, you need an agile business model that can turn on a dime when trade rules change. And 4, and this is maybe the most important, never ever stop investing in R&D. In this environment, your own innovation is your best defense.
And all of this leaves us with one last, really crucial question. For years, the tech race was all about speed. Who could innovate the fastest, who could get to market first, but now the game has changed. Is it possible that in this new era of AI, the ultimate winner won't just be the fastest, but the one who is built to last, the most resilient survivor? Now that is something to think about.